Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On this show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, franchising, and more. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. Ryan Andrews is an owner and CFO of Hiatus Homes, a real estate developer based in Bend, Oregon, that specializes in small-scale development projects and cottage cluster neighborhoods, which is something that, it's very interesting. So you're going to want to hear about that. Hiatus aims to deliver attainable by design housing for small households. Their homes are 500 to 1,000 square feet and aimed at 1 to 2 person households. Ryan also created Hiatus Capital Fund to skip the institutional investors and private equity funds and raise capital directly from local grassroots investors for local real estate developments. In doing so, Hiatus removed the stigma of outside developers sucking profits out of Bend, because the profits flow right back into investors in the community who repeatedly reinvest in more projects. In 2024, Ryan attempted to take this model to the next level as part of a community-based bid to buy the local ski resort, Mount Bachelor, which I've had the pleasure of skiing at, from its corporate owner, Powder Corp. Currently, Ryan and Hiatus Homes work in partnership with the small developers all over the country to bring attainable by design cottage projects to these communities and to fund the projects through local investors. Ryan has 18 years of finance experience and is an entrepreneur in tech, real estate, and investment management. Ryan, welcome to the DealQuest Podcast.
Thank you. Thanks for having me.
So listen, I'm super excited. I mean, listen, we've had some real estate folks on. We certainly have people that have put together funds for various things, but you have sort of unique pieces on each of these, whether it's the type of real estate you're developing, the community element to it, the decision to fund, and then the way you're expanding this across the country. But before we get to any of that, I want to take you back to when you were a little kid growing up, maybe 8, 10, 12 years old, because back then, I'm curious as to what you wanted to be growing up, because I doubt you were going to be a real estate investor and a cluster home developer and, somebody putting together finance for that at that age. But you tell me what you want.
Right. I know. Isn't it funny? When we're kids, we only know about the jobs of like our parents or our parents' friends. And those are the only jobs that we think about. But I'm probably one of the only real estate developers that actually did want to develop real estate as a kid. When I was growing up, I grew up in Southern California. And through like the late 80s and the 90s, saw a ton of development. And I either wanted to be a fighter pilot or I wanted to build buildings. And I just thought buildings were fascinating. My parents were doing fix and flips when I was a kid. And so I spent a lot of time at fix and flips that they were working on the weekends. And I'd either be like playing Legos in the bedroom and everything. But I got to work with my dad and my mom, and they let me paint stuff. Sometimes I got to use the hammer and smash drywall. And I thought it was really fun and really tangible. And then, of course, as I saw a lot of development go up in Southern California, even as a kid, I was like, who's building all this stuff? And I just really enjoyed like the tangible aspect of it. So I wanted to be a real estate developer, even when I was a kid, or a builder, whatever that meant. I wanted to make the buildings. I just thought buildings were cool. We used to spend weekends going to open houses as a kid. None of my parents were in full-time real estate, but both of them really liked real estate and did a lot of on-the-side investing. So I got quite a bit of exposure to it. And yeah, then even in college, majored in finance. Well, I first started as a civil engineer again. So I wanted to be in real estate, and related to real estate is at Cal Poly. Civil engineering at Cal Poly is a real tough major, and I was having a lot of fun. So grades weren't super high. And I was like, I think I want to switch to business. So I switched to business. But by the time I got out in 2007, it was right at the beginning of the global financial crisis. And even though I had majored in real estate development and had like a senior project, or majored in finance with a senior project or like an emphasis in real estate development or real estate finance. I graduate in '07, and there's like no such thing as getting a job as like, a young kid wanting to be a real estate development apprentice. And so I got a job in just standard finance for PIMCO doing bond management. But the whole time I was like, what is a bond? I mean, this is like, it's so esoteric. It's just a number on in a Bloomberg terminal or in a spreadsheet, and calculating duration and cash flows did not make the same sense to me as construction and actually like creating something that was real. So yeah, I mean, certainly part of my story is winding my way back. It took, almost 10 years to get back into real estate from finance because I just graduated at the wrong time, even though I knew exactly what I wanted to do for like 30 years.
Yeah, that's amazing because so many people don't know what they want to do and they find their way to it. And you knew what you wanted to do, but there were impediments to go directly there. That sort of had to take, a route that got you back there. So that's fascinating. One more question looking back, and then I do want to come back to that journey and how you got to where you are now. What was your first deal of any type that you can remember? Maybe it was something small when you were a kid or early in your career. Anything you would consider a deal?
Yeah, well, the first time I ever, I guess, did something on my own was after I left PIMCO. I wanted to be an entrepreneur. I always fancied myself as an entrepreneur. And so that meant starting something. And so I left PIMCO and left my corporate job, my suit and tie and everything. And I joined up with two friends. I moved to Bend, Oregon a couple of years before. This is like 2000. I moved to Bend in 2011. This is like 2013. Joined two friends that were tech startup guys. So one was a tech designer and like a UI UX designer, and one was a tech developer. Very different than a real estate developer. He wrote code basically. Yeah. And they had this idea for file sharing, and they were like, oh man, it's such a great idea. We've got some customers, but like, we need help. We're going to raise some money. Let's raise some venture capital. And I was like, oh, I'm a finance guy. I want to be an entrepreneur. I'll raise capital for you guys. And I'd never CFO'd a company. My accounting skills were weak at the time. I didn't know bookkeeping very well, like certainly not beyond the classroom. But I jumped in with these guys to help them raise venture capital. It took a whole year to raise $1 million from angel investors. We just like blood, sweat, and tears, as everybody says. Brutal years. Brutal year. We went months without salaries at one point, trying to monetize our app to just survive. And then it ended up, as soon as I'd raised the money, my two partners, which were majority partners, and I was a minority partner because they'd already started the company, they turned around and they were like, well, great job raising the money. We raised a lot, but not enough to keep you on payroll. So good luck. And I was like, you gotta be kidding me. And so I took that experience. That was my first capital raising experience on my own. Yeah. And, it was brutal pitching a tech product that I knew nothing about and everything at the time, but I learned the game. And so learned the game of like pitching and selling and sales and just getting out in the world and trying to sell a thing or sell an idea is really what you're doing in that space. So, I draw that experience. Ever since then, I have raising capital, and then being a CFO for projects has been my job in dozens of different companies that I've now started. I've never done anything else, but boy, that first year was hard. And it, it's kind of fun. And what happened, my partner is turning on me now, no hard feelings. I've gone on and done other things and found success, and that company ended up not making it anyway. So glad I didn't spend 3 more years at it. But it was also good going through that kind of partnership challenge and conflict, because then it taught me to start to be much more careful about who are my partners, what's written down, what's not, how does this go, and everything. So all in all, very good experience.
Yeah. So, obviously raising capital is a deal. Also business partnership is a deal. And yeah, a lot of learnings, right. Or, around that. So let's actually talk about that a little bit, because right now, right, so let's take a step back. Let's even look at your parents, right? Your parents were flipping homes. I don't know if they were using their own money or if they were financing. Well, I'm guessing if they're financing deals, it was on a deal by deal basis, maybe with lending capital. Maybe they had I don't know. And that's the way a lot of people start in real estate, right? But you moved to a very different model. And I'd love to hear, sort of your thinking on it and also how you got there, because What I find is even like a lot of times, and listen, they're all different paths people get in. So I'm not saying there's one path, but a lot of times, people do start with sort of the residential side. Maybe they're flipping some homes. Maybe then they get into a commercial building, a multifamily, maybe, right? And then they get into, into a commercial. And then at some point, maybe they're doing deals and they've been raising money either through lending or equity on an SPV or deal by deal basis, and then finally they're like, oh, we want to have capital available to be able to move quickly and have a fund, right? And that's like I said, not everybody, but that's a progression you see a lot. But so give us your journey, because I have a sense it was different than that.
Yeah, well, yeah, actually, it is. It's a little bit different story. So most people, you're right, start on kind of the bigger pockets model or whatever, using their own money, their own balance sheet, or like their parents' money or their uncle's money or something, cobbling it together. I was the opposite. I went right away to other people's money. And that came from, first of all, like, my background in finance at PIMCO, where I was managing other people's money. That was, of course, billions of dollars. I was a little tiny guy in a giant company at the very bottom. But the concept of like, oh, you just manage other people's money and you get, if you do it right, you get a slice of the upside. Where that came then is after I raised capital for that tech startup I talked about. Now I'd kind of proven my chops that like I can raise other people's money. And so after those guys and I split ways, this is where I got back into real estate. I joined a fledgling little company called CrowdStreet. And CrowdStreet was started in Bend, Oregon on the heels of the Jobs Act under this idea of like, hey, we can now use Reg D offerings to raise capital online. So let's create a software platform to do it.
Yes.
So CrowdStreet had started locally in Bend where I lived. I knew the founders. One of the guys that had been the first investor in the tech company I was in had also been the first investor in CrowdStreet. So I knew him. So I came onto CrowdStreet as like a third or fourth employee. They had not even finished raising their convertible note round, and they had not raised capital through a online yet. And so they had their first deal that they were about to start. And a buddy of mine, Darren Powderly, that was one of the founders, was like, hey, do you want to do investor relations for me and just like talk to our incoming investors that are looking at our real estate deals? And I was like, heck yeah, this is exactly what I've been waiting for. It's tech startup-y, it's capital raisy, and it's back in real estate. Like this is a perfect transition for me. And so I started working for CrowdStreet and did their first deal. All CrowdStreet had, it didn't have software at the time. It had like a user interface, and then the back end was like Excel worksheets. That's how every startup is. And so I was on the phone hours and hours a day. I started as a contractor part-time, and then that grew to a full-time W-2 role. I was with them for about a year, but I also sat next door to Darren Powderly, the founder of CrowdStreet, and I watched that guy just hammer on the phones for 9, 10, 11 hours a day. Oh, just, pitching. So he was trying to get real estate deals on the platform. I was sitting next to him trying to get investors into the one or two deals we had on the platform. And I knew, I'd spent a year slaving away as a tech startup, but we didn't work that hard, or at least, like my partners didn't work that hard, not that level of like dedication. It was kind of like this like tech startup-y mentality. And so watching Darren at CrowdStreet just work and hammer the phones like he did for a year, I was like, oh, that's what it takes to be successful as an entrepreneur. Just that level of selling and selling and selling and selling. And you get a no and you immediately dial again and you call the next one and you cold call. And how do you effectively cold call? And that year totally changed my life for several reasons. One, I saw what it takes to be a successful entrepreneur, truly, of like that level of grind. Two, it bridged me back to real estate. And then three, and this is really the thread that maybe we pull through the rest of our conversation, is it got me exposure to the new rules under the Jobs Act and the Reg D offerings that at the time, there might have been a dozen people in the United States that they had exposure to. I mean, we were on the phone with the attorneys that had helped write the legislation to have them help interpret how this goes for us. And I had access to these guys. And so I got a front row seat to the revolution of the Jobs Act, where all of a sudden, instead of deals being done in back rooms with cigars with people, as they had been from the 1930s, post Great Depression, where you got the 40 Act funds and everything, from all that legislation all the way up till 2012 when the Jobs Act was passed, although the policies weren't written for like 2 to 5 more years. So you couldn't even use the legislation till the mid 20 teens. Nobody had raised capital this way. And so nobody knew how to do it. And the internet's here and everything. And so I got a front row seat to that whole process and all those rules for a year. And that totally set me on the trajectory for the rest of my career, which was working in this space of like local investors funding local projects. And be it real estate, be it, all kinds of other investment, that was like a key piece of that story. And part of where that idea came from, and that's really as part of your intro, the Hiatus Capital Fund, we funded 4 real estate developments in Bend, Oregon from almost all local investors, like 80% local investors. It's an $8 million equity fund developing about 80 million in real estate. And so because the projects are laddered, we can keep rolling that equity from project to project, and then we put construction debt on them. So we're able to obtain tremendous leverage without risk, doing it primarily with local investors. And it's interesting doing that in Bend, Oregon, because Bend had a history, going back to the 2 tech startups that I was part of. Bend had a history of trying to fund local tech startups with local dollars. So Bend had started this thing called the Bend Venture Conference in, I think the early 2000s. And the idea was to take the couple of successful companies in Bend, get those founders together, and they would angel invest in the next round of companies locally here so we could grow the economy. Because Bend had this history of being like a lumber town, boom town, big ups and big downs. And then it became very real estate oriented. And in 2006, Bend got absolutely crushed, or 2007 and 8 by the financial crisis. So, kind of on the heels of that, a lot of influential people in the city were like, we got to get more entrepreneurs, more local businesses. We don't want our economy to just be based on real estate. So they created this model where local successful business people were reinvesting in local companies. So after my experience with CrowdStreet and my experience with 2 tech companies, both having gone through BDC, I was like, man, you can raise local money from local investors. And so that's really was the genesis of the Hiatus Capital Fund. So after I can like skip a couple of jobs because I had a bunch of entrepreneurial ventures, but I left CrowdStreet after a year, ran a construction debt fund where I lent money to developers and took that fund from about 700,000 to 20 million in 4 years. So that was big for us. Got to know construction and development finance really well from the debt side. Started my own funds, started some individual JV projects, syndications. I worked as a consultant for a big insurance company and ran about a $600 million debt fund where we syndicated debt. So I spent about 5 or 6 years, or maybe 6 or 7 years in that space as an entrepreneur, but with like a lot of different jobs. And then finally that all coalesced into starting the Hiatus Capital Fund, where we had my current business partner, Jesse Russell. He had built this really successful cottage development, and he was just finishing up. So he built 22 600 square foot cottages. And, it had been like a total field of dream things where he was like, if you build it, they will come. And everybody else was like, nobody's going to want to live in 600 square foot homes. That's ridiculous. That's a shed. And he was like, no. If you build it, like people want to live in this kind of thing. So he and I met when he was trying to capitalize that project, and I was a construction lender, and we just became friends because I thought these cottages were cute and it was kind of a tiny home thing. And so
what year was this?
This is around 2018.
Okay.
Kind of 2017, 2018. And so he ends up building these cottages, and I help him capitalize the deal just by helping him structure it as a friend. And it was, the project was wildly successful. He went out after I helped him structure it. I then slapped him on the back and was like, all you got to do is go raise $1 million. And it took him a year to raise $1 million. And he did it from friends and family, mostly that voted on him as an entrepreneur. Yeah. And we're like, we don't know about this cottage thing, but we like you. And the pictures are pretty. So they invested. And so around 2020, that project was done and built out. And we just about doubled everybody's money. If we had 100 homes, we would have sold 100 homes. And so he asked me for help to sit down and help him calculate the waterfall for the investors. Like, because I'd helped him structure the original partnership. So he's like, can you help me do the math? I don't want to screw it up. So I come back in, he and I, get some beers and sit down and work through all the math. And he's like, I told people I was sending him money back, and they were like, well, what's the next thing? Do you have another deal? And he's like, we're sending all this money back. How can we get this money back in? And because at that time I had created and operated about 4 investment funds over that kind of interim 5-year period. So I was like, well, why don't we create a fund and let's see if these investors want to come back in the fund? So we sent them out a check with their principal, a check with their profits, 2 checks in the same envelope, because we wanted to be very clear of how much money we made them.
What portion was what? Yeah.
Exactly. And then a pitch deck for the next thing, the fund, which was, this was a partially blind pool where we want to do a series of projects that are kind of cottage, small housing style projects. And so, if you're interested, send us your money back. And within 2 weeks, we gotten almost all the money back. We sent 1.6 million out and we got 1.2 back. Wow. In 2 weeks. Almost everybody re-upped. And so that seeded the Hiatus Capital Fund. Again, those were almost all local investors that had already invested in one project. But after that, we were like, well, how do we go big? And so we went and spent some time talking to private equity groups and flew to LA and did all the things. And they came to us and they were like, all right, well, here's what we're going to do. We're going to do a 90-10 split to a 12 IRR and then 80-20. And basically we scratched our heads and we were like, and then they were like, this is the only box and size we want. We don't want to do infield. We want to do greenfield development because they got to be 10 million and above and all this. And Jesse and I like looked at each other and we were like, well, number one, we don't really want to play by their rules. Number two, we don't want a boss. We'd much rather have 60 bosses than one boss that can order us around and tell us what kind of project to do. Yeah. We'd rather come up with our own project and sell it. And then the other thing is just like they're sucking out all the money out of these projects. And the stigma in Bend, especially, like a lot of small mountain towns and resort communities, are like these big out of area developers are coming in and they don't care about the community and they don't care what they build. They're sucking all the profits out and they're sending it across the country to who knows where. To, the million different 401ks or self-directed IRAs or brokerage funds that are in their big private equity funds. And everybody gets a little slice and nobody cares about the community. Yeah. So after speaking with some of these private equity shops, we came back and we were like, you know what? What we've been successful at is raising local capital from mom and pop accrediteds. That's what I'd done for the last, 5-6 years of my career. That's what he'd been successful in. We were like, let's just go grassroots and raise money in our fund from locals and see if we can make this happen. And it's been a phenomenal decision. We've had investors showing up at city council meetings, advocating for the projects and giving public testimony. And it gives you a really different kind of investor. They come out and they look at our projects all the time. We get coffee a couple times a year. They all know us. They all trust us. And, it helps too in like a post Bernie Madoff world where, they know where we live. They know where our office is. They can come and find us. We're not going to leave with their money. They know who we are and they can go and see and make sure that we're actually building things. And so it's been a phenomenal model for us. And that's kind of the whole thread of that journey over those 10 years, all the way into this real estate space.
I love it. And it's so a couple of things, it's interesting because I love the contrast you made, between sort of the one boss, the PE firm and, 60 bosses or whatever it is. But there is something about, let's talk about this capital raising thing especially when you're doing it, not from a couple institutionals or from, 5 angels, you're doing it more, more broadly. And for all the positives in the community, you also have a bunch of people who live around you and you might see in the grocery store or whatever, right?
Oh, yeah.
And listen, I've raised money. I've done some real estate funds in the past, whatever. And, listen, we had great investors, but, there's always ones that could be, they have opinions and they have views of what you're doing right, what you're doing wrong. And sometimes it's the old joke is that the smallest investors are usually the biggest pains and the loudest ones, right? And whatever.
Oh yeah. And it's so true. It's so true.
Right. And listen, it's probably because that 25 grand they put in as opposed to the 250 grand is more meaningful for them than the 250 grand is to the person who wrote that check.
Let's take a break from the show for a minute so I can tell you about an incredible resource my team and I have put together for you. Secrets of Deal-Driven Growth, Creative Ways to Grow Your Business Even in Challenging Times, is a powerful ebook that helps you take DealQuest podcast episodes and apply them to your own life and business. This is the ideal tool for anyone looking for creative ways to grow as deal makers, and you can get yours now. It's as easy as heading to coreycupford.com/workbook and downloading your copy. While you're there, you can also consider joining our dynamic deal-driven community of founders, experts, small business owners, and entrepreneurs. Now back for the show.
So what does it take to really, the conversation of investor relations, right? There's a reason why big companies have that. And certainly I think it's a mistake that a lot of entrepreneurs and developers make where they don't handle their investor relations well. You obviously gave some background where you sort of like this stuff, but what does it take, especially in a small community, to, have all these investors? Listen, you've made them money and you're doing really well. So obviously that makes a big difference, but I'm sure that they've had at least questions sometimes for why or how you're doing stuff. Like, what does it take to really do that right?
Oh, for sure. Communication, getting ahead of the communication is number one. Bad news fast is number two. And so matter of fact, I've got an investor letter all drafted. It's probably like an 8 to 10 page investor letter that's all drafted right now that I need to get out this afternoon, because it's been about 3 months since an investor letter, and they start to get antsy at about 3.5 months. I'll get 2 or 3 emails in my inbox. If I can get an investor letter out every 60 to 75 days, everybody feels up to speed and feels happy. When you're quiet, investors are like, uh-oh, what's wrong?
Yeah.
And so it's being proactive. I write fairly extensive investor letters. That's like a letter. That's like a page or two letter of just like, me talking in first person about a 1-page update with either renderings, photos, and all on each project. And then really pulling all the way back to my experience at PIMCO, where I got heavily exposed to like investment based on macroeconomic factors.
Yeah.
I sit down and write a 2 to 4 page update on the macroeconomic environment, then related to the housing market, and if applicable, the local housing market. And that's kind of my thing and my brand, just because of my background and everything, is like I've really studied and keep up to speed on the macro environment and everything. And so our investors appreciate that. And that helps them know like, oh, these guys are experts. They've got an eye on it. They feel comfortable. They're watching the trends and everything. But we've also had to send out hard investor letters. Like, not every deal I've done has made money. Outside of hiatus, I've certainly had projects that did not go well. And give that bad news fast. You're honest. You put a couple of paths forward of here's how this can go. And sometimes people get mad. Sometimes they don't. You're exactly right. It's usually the small investors that get upset and make you miserable and threaten to sue you. And to that point, I had a deal a number of years ago that was an apartment entitlement project that ended up not going through, but I had an investor as $100,000 minimum, which is pretty modest still. But I had an investor that begged me over coffee, local investor begged me over coffee to let him in at $40K. And I liked him, nice guy. He really wants to be in the deal and I really wanted the capital. So sure, I'm letting him in. So I let this guy in. And for the next 4 years of my life, I dreaded the having to explain everything. This guy would just nitpick everything but this, and everything's an accusation. And so got to be really clear. I got to get on the phone. I got to document in an email. And also you do need to be careful about it. But in general, I like the higher bar of accountability to local investors. I ran into 2 of my investors in my community hot tub because they live in my neighborhood with the same HOA and everything the other day. And I'm there with my kids and we're just chatting about life. And then, we're like, let's talk about the fun next week. Let's grab coffee and talk about it. So We've got about 60 investors in the hiatus fund right now. And I would say every time I write an investor letter, I don't know, 1 to 4 of them wants to grab coffee or a beer. And it's always a different 1 to 4, but I end up then touching them every year or two. And it's just the game of like maintaining those relationships and getting ahead of it. But to the point of bad news fast, this winter last year we'd slowed down construction because of interest rates. So we'd told our investors, hey, we're slowing down construction and this is what this looks like. And we're going to defer some of our management fees because everything slowed down. And, we're trying to do the right thing here. We're not going to lose money, but, let's try to work through this interest rate cycle and wait and be patient. And that triggered, it was funny. That one didn't trigger very much feedback. But then the next investor letter that I sent out was kind of like, hey, we're raising some more capital and like, here's the situation and here's the buffer and here's this and that. And like, because things slowed down, we need some more equity in the fund. And all of a sudden that one triggered like, a bunch of people that want to come and talk because they're like, oh, what's wrong? What's the situation? I tried to carry a tone that was very real and transparent. And that hit some investors like, oh my gosh, what else is going on? And I was like, no, that's it. We're just sharing with you. And if it came across as like a little scary, it's because we're trying to be transparent here and do the right thing. Now, pretty much most of those bumps have been worked through and we're full speed ahead on both paperwork and construction on projects because we think over the next year and next year, the market's going to just markedly improve. Even if right now, in between now and end of summer and all might be kind of rocky in the macro environment. So that's kind of just some anecdotes around how we deal with local investors and what it's really like.
Yeah, it's a fascinating thing. I mean, listen, I had we raised, like I said, a couple of funds some years back, and one of them we raised was in 2007. And we were buying we had done a couple of, so we had raised one and then we raised another add-on fund. And we had done a couple of small condo conversions that worked out nicely. And then we bought some multifamily buildings in the Bronx, New York, and up in Massachusetts. Then, I mean, obviously the whole market turned. Especially the one we bought up in Massachusetts was on it was in an area where it was just outside where the gentrification was happening nicely. Right. It was the next one to go. And then, things went to crap, obviously. A lot of immigrant tenants who went back to their home countries when things went bad, vacancy rates went up, all this kind of stuff. Right. So in that fund, after returning some money initially, we were going to take a hit. And our experience was like what you said was right. We were transparent. We were in communication. We told them everything we did. We were able to show actually that we had executed on our plan. Like before all this happened, we were able to do some improvements and raise the rents and increase the rent roll. Like it was all on plan. And then,
Right.
of course, and listen, the interesting part was our bigger investors, our sophisticated investors, there was almost no conversation necessary. They knew what was going on in the marketplace. They knew that there were way bigger developers and fund managers and investors, than us that were getting crushed, right? Who were smarter than we are. They were getting crushed. They understood what was going on. They understood it had nothing to do with us. And they understood also that we were working like hell to do the best we can to salvage stuff, either, sell it or whatever. We had one that was on the third foreclosure. We sold it back and we ended up getting, we ended up taking a hit. But I think some of those investors had sort of figured they might have lost all their money. And when we got them back, 80% of their money on one fund and like 60% on another one, they were actually pretty happy.
Right.
Smaller investors it was the end of the world. They were looking for every reason on what we did wrong, whatever. They all ended up calming down because I think when they really looked into it, they came to the same conclusion. But it was easy with the more sophisticated, bigger investors. So yeah, and I've seen that with plenty of clients as well. Talk to me a little bit about, so now, you've built this model. I mean, there's some interesting things I know, right, around like you can't even do these smaller homes in various areas, like there's zoning issues and stuff like that, but Bend lends itself to that. And now this model, you've identified that there's some other parts of the country which lend itself to this as well. And you're not necessarily just expanding on your own, right? But you're supporting other local, right, entrepreneurs and developers to roll this model out. Talk to us a little bit more about that.
Yeah, I mean, that's the next series of deals for sure. So for years, Jesse and I scratched our heads and we are like, how do we expand out of Bend, Oregon? We don't want to just be Bend, Oregon developers, and this Bend, Oregon is not the only place in the country that needs small cottages and, attainable by design and homes for 1 to 2 person households. I mean, that is a national issue. Single person households is the fastest growing household formation component of in the United States. It's now 29% of all households are just a single person. And just 10, 15 years ago, that was low 20s percentage. And so it's growing in actual number and as a percentage share of all households rapidly. Right now, they either have to buy a 3 bedroom home in the suburbs where every trip's going to be a car trip and it's going to be harder to build community. And those homes are unattainable by design. So they might need another unrelated adult roommate. And what, 35-year-old wants a roommate, So they would much rather have their own small home and then have community oriented design created into the site and into the neighborhood where they can then choose hey, I have my private space, but I can also go meet my neighbors and hang out around a community fire pit in a community garden. And so that's become a really core piece of our design. It's the small homes and the sites. And the way it really happened is kind of an interesting story. We hired a group to help us do social media marketing more nationally because we were like, hey, we want to raise capital from investors, not just in Bend. We want to raise capital from investors, all over. So we started running social media ads with pictures of our cottages and everything all over the country. And within a couple of months, about half of the inbound leads were people that were like, hey, can you get me 10 of these in Florida? Hey, I've got a property in Sioux Falls. Can I get one of these developments in Sioux Falls? And it kept being like, no, actually, this is a fund. You give us money. And then in a couple of years, we give you your money back with some more money because you're investing in our deals. And, we just cast such a broad net that we didn't hit our right target market. But what we uncovered was a massive amount of demand for our business through a different business model. Yeah. So after a few months of that, after fielding hundreds of calls like this, Jesse and I were like, okay, how do we roll this out? How do we sell our designs more broadly? So we started to roll out a business where we said, we will sell hiatus designs to people to put on their own land. And depending on where it is, we'll also do the permitting. We'll maybe do a site plan and work with a local civil engineer to design your infrastructure and everything. And so it rolled out as a piece like that, where we were like, oh, this is how we expand is local developers. It's not us hiring a W-2 employee in Fort Worth. It is somebody that's like a developer or an aspiring developer that wants a more experienced group to come alongside them. Or maybe they have land or something. And so they started reaching out to us. Almost always they had connections to my friend is on city council, my neighbor's on the planning commission, which were not hooked up to any other jurisdictions, outside of Oregon. Right. So they became the boots on the ground. We became the experts. And at first the offer was hey, we'll do this as consultants. Yeah. And then what we found is everybody for a small development is looking for the money. And so they were like, well, do you guys have the money? Where's the money and everything? And so we were like, well, okay, yeah, we would totally partner with you. And so here's how that might work. We'll set up a partnership. We're experts in raising capital locally. So we will help you close your local investors into this fund because that's the best thing for you. That's the most sustainable thing for you. And, I will be on the phone with you and your investors helping you close them. You get them excited about the vision, you get the relationship. I will come along and talk them through the subscription agreement and the operating agreement and what happens when shit hits the fan. And what happens when, we're distributing profits and everybody's high-fiving, talk them through that. And so basically, I will come on and help you close your investors. And if it's a project that is close enough to our business model, we will even market it to our 6,000 or 8,000 investors and bring some of them in. But we generally don't want to lead a project out of area where we're like, hey, right, we're just going to come in with all of our out of area investors and fund your project and suck all the projects out. We're like, no, we've got a pretty strong value or core value around being we want you, local investor, to have local capital. Almost all of them were like, hey, could you get 20 people on the phone that could write $100 to $250,000 checks each, and you don't have to close them. You just have to like get them to love the idea and get them on the phone, and I'll help you close them. I will CFO this project for the next 2 years. I will get them their distributions and their investor letters and their filings and their K1s. You don't have to worry about all that. You just have to like get them to buy into the vision. And that's where this whole business model started to like hit that parabolic growth, because people are like, well, yeah, okay, it's this new type of housing. It's these new designs, smaller homes, new type of community, smaller homes. Oh, and you can help me raise the capital locally. Like, okay, we just removed all the friction except for one. And that's the one that you kind of teased at the beginning, which not every jurisdiction allows this. And so you're exactly right. So we either need to pick jurisdictions that do, and that's research that we'll do up front. There's a lot of cities all over the US passing cottage code and cottage cluster community courts and all kinds of different building code on it. But what's also happening, which like we didn't totally expect, is a lot of times these communities, especially smaller communities, like we're working on one in Utah right now. We just started, and they're like, well, we don't have any cottage code. We don't know what that looks like because we're a small town, but we want this type of housing. There's demand for it. And if you guys tell us what kind of building code we need and what kind of building code Ben did, we'll just vote on it and implement it. And then you guys can build what you want. So at first we thought we're only going to be able to strategically be in these communities that have passed this legislation. And then we realized, no, as long as there's a desire, though there is so much demand in so many communities that they're willing to pass conditional use permits, change zoning, change building code, all the way down to the point of we've thought about like, man, what if we had a book that we could hand to these cities that was like, here's the code in the incentive packages you need to vote on and pass as a city council or a county commission in order to implement attainable by design, infill detached cottage style housing. You know, here's your playbook, city. Like, vote on it. It works. It's been tested in many communities now. And so we haven't quite had the time to put that package together, but maybe next year. So I think as we get more and more into these communities, what we keep finding is even if the zoning code isn't there, we talk to a local real estate attorney and we talk to local planning commission, and they're very friendly toward like, oh, this is a great type of housing. We need this in our community.
Interesting. Now you're taking pieces, you're partnering in, you're taking pieces of these projects.
Yeah, we are. Yeah. So we will co-GP projects like that with people. And every one of those deals is custom, but we basically will draft partnership agreement that's fair. We'll do the economics on it based on the economics of the project, make sure our partner has their slice of the GP. We get a slice of the GP, and, you know, everybody's happy and everybody's raising capital together. So it's not like they're slicing profits off of their investors and we're slicing profits off of ours. It's not that, like, that's kind of a private equity style, like 90-10 model where we bring in our investors, but we take a haircut off of them. We don't do that because we want to be like, hey, we want you, the local boots on the ground, on the phone with our investors that we're bringing in from Bend that don't know Nebraska. And your investors, we want them on the phone with us because we're bringing the expertise and the design and the financing. So we just want everybody on the same page. But yeah, we'll figure out a split. And sometimes we're a minority partner. Yeah. Maybe they're raising all the capital locally and we're just helping them as like a CFO and structuring and designs. Then we're very much a minority partner. If we're bringing half the capital, then we're the primary decision maker when it comes to, like, you know, design and development and the major decisions and everything, because we're bringing all the expertise and all the capital, and a big chunk of the capital. So we split those up in the fairest way possible, but they're all custom.
Totally makes sense. All right. Before I come to my last couple of questions to close this out, because we're actually a little over time, but I can't let you leave without telling this story about attempting to buy the local ski mountain, because that's too much fun not to have you talk about. So talk about that journey, you know, relatively quickly, but I want to hear about that.
Yeah, I'll give you kind of the quick version. Super fun deal to be a part of that ended up not quite going through, although a no is always just a not now, not a never. And that's how I view that. So Mount Bachelor is one of the largest ski resorts in the country. Massive, huge volcano, 20 minutes or 18 miles outside of Bend, Oregon. And it's unique because there's no resorts or anything at the mountain. Everybody stays in the town and patronizes the town and the local Airbnbs and the hotels and the restaurants. The town cares a lot about the mountain. It generates a lot of economic activity for Bend, Oregon. So in August, Powder Corp, which owns a bunch of ski resorts, Powder Corp announced in August that they were going to sell Mount Bachelor, or were going to list Mount Bachelor. And they weren't putting up a number, but it was like an open bid auction process, and they were encouraging people to make offers. So like that afternoon, a bunch of the online ski and snowboard community in Bend was just a buzz like crazy. And a couple guys were like, hey, you know what? Like, we should buy the mountain. And one guy was like, well, I got $10 on it if you do, and everything. And then two of those guys, Dan and Chris, kind of like pinged each other, like DM'd each other later, and we're like, hey, were you like kind of serious about organizing that initiative? And one guy is just been a Mount Bachelor fan for decades, lived here forever, but is like an appraiser and not into resort operations or fundraising or anything. The other guy had been in M&A in Portland and then moved to Bend to be a business teacher. So we'd like moved to Bend for the lifestyle, loved Mount Bachelor, moved here for the mountain and everything. So those two guys connected, and within a day or two got on local news being like, hey, we're going to raise money. We started a Kickstarter. We're going to raise money. It wasn't Kickstarter, but some funding thing. We're going to raise money in order to explore buying the mountain. The community should buy the mountain. And they set up an email address, buymountbachelor.com or whatever. And they got like in 24 hours, got like 2,000 emails from people, including very wealthy people that were like, I would write like an 8-figure check in this thing. And, or what do you think this is worth and stuff like that. And so shortly after that, when I saw these guys' news thing, I sent him an email and I was just like, hey, do you have a finance guy to run your securities offering and like CFO the deal and put the deal together? And they were like, nope, and adopted me within about 24 hours, right? And so we then spent about 4 or 5 months going hard, David against Goliath. I mean, Vail was looking at it, Alterra was looking at it, Mountain Properties was looking at it, like all the heavy hitters, some public companies and everything were coming to look at this thing and kick the tires. And we were gaining national attention because we were this like little local group. I mean, like the New York Times came out and interviewed us and like, went to the mountain and everything. And this thing got very real in the sense of, I think we could have raised around 100 million in equity to buy the mountain. And I think we could have gotten another like 50, 60 million in debt and would have paid 150 million to buy the mountain totally. And matter of fact, I went on the news, or a clip of me went on the news and got hundreds of thousands of hits where I'm like, we're buying our backyard. We're not looking at this ski resort versus that ski resort. We're willing to pay more than anybody. We're not looking for the best deal. We just want to buy our backyard back. And that went, on it. And because it's a bad negotiating tactic, but I wanted Powder to talk to us and they wouldn't. Yeah. They would not engage with us. And so we got on the line with like the investment bankers and they made fun of us and told us we needed somebody with $35 million in a bank account that we could show them before they'd take our next phone call. So we actually went and found somebody that had that and was willing to show it to them. And so we got back on the phone with them and our investor guy that was willing to be a lead investor and totally had the network and the net worth to get the deal done, north of 100 million. And the investment bankers still pissed on us and like wouldn't talk to us, were offensive, made fun of us, got off the phone. So the next day we FedExed a letter to the board of directors of Powder Corp and the chairman, a paper letter that I wrote that was quite aggressive and terse and then got softened and before it got finally sent, which is probably a good idea. But then that didn't garner any response at all. We tried everything except for flying to Utah and knocking on the door, which I was ready to do. Right. If I'd had like a free weekend, I said a couple times, like, let's just fly to Salt Lake City and knock on the door and talk to these guys. And so ultimately, after they refused to engage us, despite the fact that like, I think we were in this chicken and egg problem because like we couldn't actually raise the money and deposit it in the account, but we could get like LOIs, but we're trying to get Powder Corp to talk to us. So ultimately, then all of a sudden, by the time we had the majority of our traction, the investment bankers were like, oh, actually, like it's not on the market anymore. And we were like, oh no, somebody bought it. Who bought it? And then about a month later, it came out like, oh, actually, Powder Corp just took it off the market. They're going to keep it. And so my immediate thing was like, well, that doesn't mean no. That just means not now. We need to now approach Powder Corp and be like, hey, can the community buy in to, at 10 million a year till we've got a $50 million position or something, like, because there's 50 to 60 million in deferred maintenance in that mountain, which we think is one of the reasons they were selling it. So we want to be like, hey, why don't you let the community pay for the maintenance? We care. And then we own a little ownership slice and maybe get some voting rights and a little economics. And so I think the deal's not dead. No, everything is always on sale at some price and on some terms, but that was the kind of 8-month trajectory of trying to buy our mountain back for, I don't know, 150, $200 million. And maybe there's still legs in it. We'll see.
Well, I'm sure that's a phenomenal experience. I mean, yeah, buying a mountain would be very, very cool. We had a mini version of that when I was and it was not even close to this real. But when I had a ski share at Killington, when I was living in New York, and I was forever ago when I was in my 20s and 30s, and there was a small mountain that had closed down called Round Top Mountain, where we had a condo on the top of it, which was near Killington, and this was in the days when snowboarding was first coming in, and most of the ski areas were banning it. Like, you couldn't snowboard, right? And we thought we had this idea, which we never followed through on, but we actually looked into it. We tried to find the owner to make Round Top Mountain a ski board only mountain, right? Because again, at that time, most places you couldn't even, they had no slopes. And a couple of the ones had like, oh, these 2 slopes the snowboarders can be on. Obviously, in the long term, it wouldn't have been a good move because they opened it up. But we looked at this little mountain, which we used to ski down with our rock skis sometimes on the old slopes that were all overgrown and whatever, and then drive the car back up a mountain. So that was my.
Yeah. It's a fun idea. And I love that you brought up Killington because they actually did this model. They were a Powder Corp owned resort, and they sold to a small group of closely held investors. Now, it was not a democratized group like we were talking about. We were literally we're going to take it down with, I don't know, I'll say like a few to several dozen ultra high net worths, $1 million to $10 million investments. And then we were going to turn around and do like a Reg A plus offering and be like, hey, if you've got $1,500 so you could buy a season pass, you can buy an ownership share in Mount Bachelor. Yeah. So that was we were going to go all the way down. Killington sold from Powder under a similar model just recently, but it sold to like a small group of high net worth investors that were local and everything. And that mountain had, I think, a ton of deferred maintenance that needed to get done. So those investors bought it and are working through the deferred maintenance. But, after it kind of gained some traction in the news of what we were trying to do, we had several other cities reach out to us and be like, hey, we want to do this. How do we do it? How'd you guys get the traction? How are you going to structure this thing? And so I think there is an interesting trend where we had a lot of consolidation into like private equity and holding companies and large corporate conglomerates. And I think that is now shifting to a more democratized version because you don't need so many intermediaries anymore. Now, those conglomerates were themselves almost, you could call them like crowdfunded because they were made up of like millions of little brokerages accounts and 401ks, and they were made up of a bunch of retail investors at the end of the day anyway. Everything is. But it's just, you can cut out 2 to 4 to 10 of the middlemen in the financial system. Yeah, today. And now you can go directly to the investors, and you just need to know how to structure it. You just need to know how to market it, and then need to know how to manage the investors. And with software now, there's so many good investor relations softwares that like, it's not like tracking it on paper and in spreadsheets like 20 years ago. So, I mean, the game has changed, and I think we're going to see conglomerates break up and all kinds of things, from real estate deals to ski mountains to whatever other amenity resorts or whatever go back to being owned by local investors, or at least owned directly by investors that know what they own. It's not like they own a brokerage slice of this conglomerate holding company, which is a private equity fund, but you know what I mean? Yeah. Where there's like so many layers and so many finance guys taking a haircut off of each step.
Yeah, fascinating in terms of that potential trend. Yeah, listen, there's so much more we can talk about, but we are at or really past normal time, but that's great because I didn't want to miss that story. So Ryan, if people want to find out more about you and what you're involved in or anything you want them to know about you, where do they go?
Yep, hiatushomes.com is our website. Matter of fact, you can see a lot of our cool homes and stuff there. And, Ryan at hiatushomes.com is an easy way to get a hold of me. We don't have gatekeepers at this point. We're just trying to grow and do business. So yeah, I would love to chat with anybody that's got projects or interest or stories or whatever.
Awesome. And Ryan, my final question on the podcast is always about my highest value in life, which is freedom. And for me, that means everything from freedom around the world for people from oppression to being an entrepreneur, not having a boss for decades. What does freedom mean to you, and how does it impact your life and business?
Good question. It's time with my kids. Last week was the first week of summer for my kids. And so I have them in the summers. I have my kids week on, week off. They're with their mom 1 week, with me the other week. And having the freedom to spend time with them is just awesome. So, it was a busy week, but I was able to take most of the time off. I had my kids out up at the cabin that we have up in the Cascades. We did chores and split wood, and we got bit by mosquitoes and had campfires, and then went to the rodeo. And truly, it's really important to be able to take that time away from work to do what you love and be with the people that you love. And so at this point and at this stage in my life, that's totally what it means for me. I've got 3 daughters from 7 to 11, and these years go really quick. And a lot of dads are grinding in their 40s in this season of life, and maybe grinding in a corporate job where they don't have a lot of flexibility. And so I just couldn't be more thankful and grateful that I have that freedom and that flexibility to run my company. But also, I've got 60 bosses. I'm in a very slow business. Real estate development is nothing's ever on fire. You're just working through the issues, working through the paperwork and everything. And so I'm really grateful for that. And that's definitely what it means for me to not be chained to the desk all the time.
That's awesome. Ryan Andrews, thanks for being such a great guest on the DealQuest podcast.
You bet. Thank you.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. If you are interested in finding out more about my law firm, the services we provide to entrepreneurial and growing companies across industries all over the country, and my partner Brian Megan and I, and my amazing team, just head over to kupferlaw.com. That's kupferlaw.com. And if you want to follow more of my content, head over to my LinkedIn page where I post regularly. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.